This is Under the Lens, featuring economic research by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on facts he feels to be accurate as a result of his research at this time. All listeners are advised to independently verify all research for market changes. The following opinions are not in any way a solicitation for business, nor should they be considered investment advice. You should always consult a registered investment advisor before making investment decisions. Now, let's join Gordon for today's show.
It is Wednesday, November 23rd, 2016. I'm Gord Long. As is normally the case, I have a lot of charts for us to go through this morning, so therefore I will pass over some of them quickly but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing or you'll not be able to see some of the detail I'll be discussing in the charts. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's Global Macro Tipping Points Research Report document. The research document this month updates U.S. economic developments. Therefore, the slides this morning will focus on our other three report areas of our monthly report, the global risk, macro, and regional developments. As I often do, I'd like to tie them together into a single discussion on investment strategies for what I will call Trumponomics. In this regard, I'd like to cover the following subject areas this month: a situational analysis facing Trumponomics and insights from one of Trump's top economic architects to see if we can make some sense out of what we can expect. Next month, I hope to continue this on strategies and investment focus areas specific to our analysis. For decades, America's policy mix has been great for financial asset prices, but less so for incomes and GDP. Institutional bond investors have been all in on secular stagnation. Globalization was creating sustained deflation. A global aging population was further exacerbating the problem. Robotics was advancing on all fronts, and a global savings glut, think of that as corporate profit levels, was creating huge demands for yield, thereby pushing up bond and asset prices. Could Trump reverse this? Will Trumponomics break this cycle? A suddenly imploding bond market, spiking yields, and higher inflation expectations are initially suggesting Trumponomics is potentially reversing this thinking. But is this only a poorly thought out overreaction? Let's first do a quick situational analysis of the environment that Trumponomics faces. The United Kingdom's Financial Times reports in a feature article that a lot of investors are now expecting President-elect Trump to be the economic love child of Ronald Reagan and Lawrence Summers. Only a British tabloid could say that. But anyway, the tabloid suggests that if implemented, a combination of the following could certainly be a bullish cocktail for investors in the short term: a pro-business tax, less restrictive regulation policies, increased defense spending, and infrastructure spending. But those buying into this euphoria should be careful to read the small print. Investors are buying U.S. stocks, especially bank stocks, on the assumption that Donald Trump is going to reflate the economy in a way that will benefit Wall Street more than most. That looks like a good bet, given the emphasis among his close advisors on unpicking post-crisis bank regulations, cutting taxes, and pushing up interest rates. All those things will make it easier for banks to make money. Selling bonds to buy equities is also likely to be a profitable strategy at a time when the U.S. was already looking at the prospect of rising inflation and looser fiscal policy long before November 8th. But now for that small print. Although President-elect Trump is likely to preside over a shift from monetary to fiscal support for the economy, not all fiscal expansions were created equal. We are now 8 years into a slow recovery marked by stubbornly low productivity and weak private investment. Increased public spending to support long-term potential growth could be a win-win for the U.S. and other developed economies. I'm expecting a major shift from monetary-centric economic policies to fiscal-centric policies to begin to occur over the next 18 months. But even if Congress lets the new president have his way on the budget, his focus has tended to be on tax cuts for businesses and public-private partnerships to boost infrastructure spending. More carrots than big stick approach, which we have been seeing for some time now. Of course, we have potential tariffs being a big stick that could be unintentionally or maybe intentionally put in place because of Trump's policies and views on trade, or what he calls fair trade. Trump has not talked at all, as best I can determine, about investment in skills and education. For example, which businesses, especially small ones, frequently cited as the greatest barrier to faster U.S. growth. As Lawrence Summers himself has pointed out, public-private approaches to infrastructure investment are going to leave a lot of the high-priority projects out that small business can take advantage of. There is a huge amount we don't know about the President-elect's plans, but overall, the kind of policies he suggested spending money on are not those that economists would say are likely to give the highest economic return. If that's right, any short-term boost to growth will come with a shortening of the economic cycle rather than an increase in U.S. potential growth, and thus bring the date of that next U.S. recession even closer, the one I've been forewarning for some time about. The message for investors in U.S. equities is enjoy it while you can and mind the gap between expectations and reality. So the small print for the rest of the world from this post-Trump rally is that policymakers do not have a lot of time left to reflate their economies before the global cycle turns negative, and it's already turning negative, and challenges become that much greater. Some would argue that rising U.S. inflation and interest rates will make it easier for the Eurozone countries to recover by giving European policymakers more room to import inflation via weaker currency. But the rout in the global bond market means that financial market conditions have tightened sharply since last week, at a time when core inflation shows very little sign of rising above 1%. Slowly but surely, fiscal policy had been playing a more supportive role in the Eurozone, just as many economists have long suggested. But that increased government spending has been indirectly bankrolled by the European Central Bank through the dramatic fall in the cost of servicing long-term government debt. The risk for the EU bloc in this new environment of rising global real interest rates is that looser fiscal policy becomes both more necessary and a lot more expensive. That makes it even more important for European policymakers to embrace the right kind of structural reforms and the right kind of investments in long-term growth. Europe needs those things a lot more than the U.S. does. The final piece of the small print is also the most obvious. Buy into this Trump rally if you want to, but be warned that a further period of Wall Street doing better than Main Street is not going to silence the populist forces that got Mr. Trump elected. A global economy that does not deliver for a large proportion of its citizens is ultimately not going to deliver for investors either. Economist and Trump's top economic architect, David Malpass, offered his insights and thoughts on trade, debt management, and monetary policy to the Wall Street Journal after Trump won the election, while cabinet members were being selected to specifically implement Trump's policy platform. I want to examine each of some of the insights offered by David Malpass that gives us some guidelines for investment strategies and frameworks on renegotiating the North American Free Trade Agreement. Malpass suggests that NAFTA was supposed to be very clear, free market orientation that would allow both sides of the border to do what they do best in the classical sense of more commerce. But as it was negotiated year after year, special interest descended upon it, and it got thicker and thicker and thicker. This was in 1989, 1990, and into 1991. It's up to 1,200 pages, and then Bush left, and then Clinton came in and added the environmental chapter and the labor chapter. It became this monstrously large managed trade process that doesn't work at all for small businesses in the U.S. According to Malpass, there are just too many parts of it that are not working. Apparently, there is supposed to be a regular annual review between the parties of the NAFTA to see where it's not working well and to have a constant process of renewal in it. That's been dropped. He's suggesting that is something that now needs to be looked at. So what should we expect? expects highly publicized reviews of NAFTA and other trade agreements, but with little change at least in 2017, possibly into late 2018. On the federal debt limit, we have $20 trillion of debt, and Washington's response to that is to continuously suspend that debt limit because they can't meet it. It therefore just keeps going up. There will again be a temptation in Washington to simply suspend it, which is a non-workable solution for the American public because in the end, they're going to have to pay that national debt. Malpass suggests we must recognize that this has been a complete failure of the law. We ought therefore to have a way to rewrite the law so that it at least attempts to control spending before it becomes debt, rather than after it becomes debt. What to expect? We expect a highly publicized and contentious change in the wording of the law. Meanwhile, spending will increase, the balance sheet will increase. On the Federal Reserve, Trump has talked about the politicization of the Fed. A way for people to think about this is the Fed is an independent agency within the U.S. government. That we want. However, the results of the Fed's policies have been highly disappointing. For years, in 2010, 11, and 12, the Fed would start the year with an optimistic forecast that, due to the stimulus, it was providing the economy was going to grow 4%. Then as the year went on, they'd lower their forecast to 3%, then into 2%. We're now at 1.4%, despite the Fed thinking that has pedal to the metal in terms of stimulus. That's a grievance that needs to be brought from the American people to Washington to say, this system that we are running simply doesn't work. Trump's context of wondering about the political inclination of the Fed is that the governors are approved by the Senate. They have political leanings. So there's a problem in thinking about, are we getting the best policy? We need monetary integrity. We need to have a situation where the U.S. dollar is a trustworthy currency. Malpass would like to see the world's most trustworthy currency. We don't have that in the current system. What can we expect? We expect the Fed to reverse course and loosen rates and credit in late 2017. The central bank balance sheets, as I said, will continue to rise in a linear manner. Meanwhile, Trump will make changes to how these governors are appointed and to who the specific governors are going to be. On infrastructure spending, few Americans disagree we need vastly improved infrastructure. Trump's economic team feels we must implement a system where the private sector wants to finance a lot more of this infrastructure. There was an article in the Wall Street Journal showing that around the world there is $50 trillion in cash. 12 trillion of the cash is in negative interest rate yielding bonds. The writers of Trump's infrastructure plans show that all you have to do is show how an infrastructure project that returns zero, meaning so for 30 years you're going to have a bridge and it's going to break even. And that's good enough to beat the hurdle rate that the market is choosing right now. So it seems clear to Trump's team that what's broken in this system is not the sources of the financing for infrastructure, but the obstacles to actually getting it built. So that means property rights, that means permits, that means the choice of projects, that means the interstate cooperation. In New York State, David Malpass argues we have this giant problem where the infrastructure is jointly owned between the state, New Jersey, and the city of New York. So imagine trying to get those three actors to agree on a tunnel under the Hudson River or whatever the project you want to be. What do we think is going to happen? We expect infrastructure spending to be fast-tracked through Congress the moment there is a whiff of a recession or the markets start to fall. This is a no-brainer for Congress and will be easily accepted by the public. On debt management by the U.S. Treasury, right now the U.S. issues a certain amount of long-term maturity. So every treasurer in the country, in the corporate sector, is trying to lengthen the maturity of their debt given the low yields that are available. So we just saw Saudi Arabia do a gigantic bond deal at 3.5 interest rate for 10-year securities. And it was presented, rightly, that will help stabilize their finances. So a lot of developed countries are issuing huge amounts of long-term debt right now because the market wants the debt and because that will benefit the taxpayer for the long run. Remember the trade-off. That means in the very short run, your interest costs go up a little bit because you're lengthening the maturity. Now every corporate treasurer makes that trade-off and says, I'd rather have the stability of the long-term debt. So here's the problem. The Fed has been buying up large percentages of the long-duration debt. So every time a bond comes due at the Fed, they roll it into a long maturity purchase back. So they're buying back the debt that should be in the private sector. So one thing the Treasury should be doing, to Trump's point, we should be financing the debt in longer maturity. That means as debt comes due, issue longer maturity, and that would protect the taxpayer and be a logical thing to do. So shouldn't the U.S. government be doing that, and why aren't we? Well, because it makes our budget deficit look good for 1 year, but the cost of that is for 30 years. You're missing the opportunity to lock in those low rates. What do we expect? We expect the self-acknowledged king of debt himself, Trump, to borrow heavily at as cheap a rate as the Fed can possibly engineer. Trump's chief strategist, Steve Bannon, has made that abundantly clear. On Dodd-Frank financial regulatory law, Dodd-Frank hasn't worked. Lots of luminaries, including Alan Greenspan, have pointed out that it's just an unworkable concept of a law, and so how do you begin to get back to a system that works for the average American? Jeb Hensarling, who's the House Financial Services Committee chairman, has a comprehensive bill on various segments of that problem, and those are well received in the campaign. He is a Trump candidate for Treasury Secretary. Obviously, the Trump team have their eye on something here. What do we expect? We expect the Trump administration to be very forceful in rolling back red tape. Trump has already stated post-election that for every new regulation, 2 must be rolled back. On carbon pricing to address climate change, Trump feels this is not a market-based way to have more energy benefits for the nation from the huge resources that are here. He won a couple states based on this discussion. Expect more here. There's investment opportunities here, we believe. On a housing finance overhaul, the current housing finance system is very government-centered. Fannie and Freddie are doing a giant percentage of the conventional mortgages. There hasn't been much ability to regrow private label mortgages, and so that's a system that must be too Washington-centric. Now, whether that gives you a path in Washington, there's now many plans on what to do with Fannie and Freddie, probably 24, right? I think the direction of the administration would be to change the housing finance and improve it so that it works better for the average American. If you look at the skewing of the average mortgages that are being given right now, rich people are doing a lot better on their mortgages than average people within the current regulatory structure. I think the appointment of Ben Carson at HUD, or a nomination rather, is targeted at doing some of this in specifically the inner cities and lower developed areas. What do we expect? We expect something creative to occur here. Trump understands better than anyone how to finance mortgages. He's interested in this. He's got a sense of understanding of it. A slowing housing market will force early action regarding housing here. First, we are skeptical that much can effectively be done soon enough by the new Trump administration to avoid a pending U.S. recession in 2017. Secondly, even far worse, is a reasonable probability of a global deflationary bust beginning in 2017 as global trade steadily continues to erode. Thirdly, we see major discrepancies in Trump's policies which could derail his pro-growth mantra. The most pressing is the damage a strong U.S. dollar is doing to profits, exports, and global trade, and the rising yields which are crippling the collateral values of the bond market, which are highly leveraged. We will soon post a dedicated SII, Strategic Investment Insight, with an investment watch list for this Trumponomics, and we will follow this up next month where we talk about strategies and investment areas to focus on. So in closing, remember, the answer will be, as it always has been, to simply print more money. It's the only answer politicians will ever agree on, so invest accordingly. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2016 turn out to have been an outstanding investment year for you and your family. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.